So here are your debt payoff strategies. You've got debt snowball, debt avalanche, cash flow index, using a whole life insurance contract via the cash value, 401k/retirement accounts, take via loans, actually loaning against investment accounts, right, or margin loans to pay off debt. And then the one that I'm most popular for on YouTube, velocity banking, okay? So these are all of your what? Debt payoff strategies that exist that don't involve increasing income or reducing expenses, right? The only other strategy that you could make an argument for is the strategy of increasing income, but then I would simply say that's an external factor. Anyone can decide to do that and still do debt snowball or still do avalanche or cash flow index, right? Velocity banking. Let me share the definitions of these different strategies the best way I can explain it. So this should be nice and clean. You should be able to see debt elimination strategies. So I'm going to begin. So debt snowball is taking the lowest debt balance to the highest. So when you're looking at your personal finances, you basically want to look at every single debt that you have in your name, right, or spouse, right, as a household, and you want to see which debts are the lowest all the way to the highest, and that's how you're going to rank your debts. So the advantage of debt snowball in that regard is it's technically the simplest strategy on the board of debt payoff strategies. It's the simplest one. You're only focused on the balance, okay? The cons here is mathematically that might not make sense all the time, right? But math is not necessarily a factor in the debt snowball strategy. It's all about momentum, confidence, early victories, simplicity, right? It's a paradigm shift for some. And the advantage with debt snowball is it's one of the longest standing strategies, proven. It is tested and proven under many different economic environments. And debt snowball has been practiced by probably, I'd say, millions, tens of millions of people, hundreds of millions, more than likely, across the world, honestly. So that's another factor, is debt snowball can be practiced anywhere in the world, right? It's not limited to a particular jurisdiction or way of a specific banking system. So it's got a long track record of success, right? And so therefore, debt snowball is often a very attractive way to pay off debt. Simple. Just involves making extra payments towards your lowest debt balance. And then once that lowest debt balance is paid off, you take that payment and you apply it to the very next debt and you keep it moving, okay? Debt avalanche is a little more specific, right? Slightly, but also pretty simple, pretty straightforward, right? Debt avalanche focuses on the highest interest rate debt that you have and goes to lowest interest rate, right? So you might have a car loan with a balance of only $10,000 and the interest rate is, I don't know, 3-4%, and then you've got a credit card at $15,000 with a 25% interest rate. If we're just looking at those two debts, Debt Avalanche would say pay the credit card off first, then the car. Debt Snowball would say pay the car off first, then the credit card, because the car, right, has the lower balance, right, 10K as opposed to 15, right? So pretty straightforward. Cash flow index. This is where we get a little more tactical, right? Now we're starting to focus less on the emotional benefits, right? Or psychological benefits. Now we're starting to focus on math. It's a pure math problem. So if you're the type of person that's less emotionally tapped in when it comes to your money, right? It's less of an emotional decision. It's more of a mathematical decision. And I know typically amongst majority of my clients, especially with men, typically we're solving a math problem. When I work with moms, it's usually an emotional, mathematical problem we're trying to solve, right? Just makes sense, right? Just understanding the difference between men and women, right? So when I talk to most men, it's a mathematical problem that they're trying to solve. Denzel, what's the fastest way to get out of debt? Every now and then I do get moms and women that are also mathematically minded, And I do attract those as well just because of the way that I present myself on YouTube. I tend to be less emotional and more tactically, mathematically involved in whatever strategy I'm trying to solve for, right? So cash flow index takes the balance owed on a debt. So it doesn't matter how you order your debts, okay? You just make sure you got all your debts lined up, and you just start with the amount owed divided by the monthly payment, the monthly minimum payment, not the payment you're making, right? So if you're making a higher payment than the required, don't use the higher payment. Use what's actually required to pay that debt each month. Balance owed divided by monthly payment equals cash flow index score, and you go from lowest number to highest number, okay? So it might tell you to pay off a credit card first, then a car, then a this, then a personal loan, then jump back to student loan, then finally the mortgage, right? So it's always going to be purely based off the lowest number, right, all the way to the highest number. That's the order in which you'd pay off debt, right? So moving right along, we got velocity banking. This is like I think my favorite way of explaining the strategy in like 2 sentences or less. But being able to leverage velocity banking is being able to leverage a line of credit to accelerate / consolidate debt into the line of credit, right, at a cheaper cost of money per day. Then using all of your income at the same time to pay off the line of credit fast. Rinse and repeat, okay? Velocity banking, I could spend hours and hours and hours, which I've had hundreds of hours in case studies explaining the strategy, and it takes people a while to get it because it is way more of a mathematical problem we're solving for. It involves more thinking, right? It involves taking the time to get really educated on your specific scenario while using other case studies for reference, right? Velocity banking does not have an extremely long track record of success. I'd give it maybe 20, 30 years, right, of a track record of success. Whereas something like Debt Snowball or maybe Debt Avalanche or Cash Flow Index probably has a 50+ year track record, maybe even longer if we're looking at the whole world, right? You could say Debt Snowball, before it was called Debt Snowball, was the way to pay off debt, right? So it's got a longer track record, more history of success, whereas velocity banking is being taught by a bunch of people that typically don't have a whole lot of financial professionalism in the traditional sense, right? You're not typically learning from someone that went to an Ivy League school or someone that got a college degree or someone that, has a PhD in mathematics. You're typically not learning velocity banking from that kind of person. So it also adds another layer of risk, another layer of uncertainty, doubt, fear, right? Skepticism. Because if you look at the top people promoting velocity banking today on YouTube alone, literally those people, and I'm talking about myself, are people that don't have financial professionalism in the traditional sense, right? I'm not a Series 66 license. I didn't go to Ivy League school. I didn't get a mathematics degree. I didn't get a degree in finance. I don't have any of those. What would we look at as credibility, right? Or experience? I don't have any of that, right? I'm basically self-taught. And then you look at people like Christy Van or the Kwok brothers, right? Or Matthew Pillmore. Like, as far as I know, they did not go to college to get a finance degree. They did not become a financial advisor. They did not, study mathematics, right? So again, it has its pros and cons there that you have to kind of weed through to really get to the core math of what's happening. But those 2 sentences right there really summarize, I think, the strategy in a really, really good way and can be used as a foundation. The next one is infinite banking, okay? Now, infinite banking today can be described 100 different ways, just like velocity banking can. Because within velocity banking, you've got the general sense of the term that I just gave you, but there's like 25+ different ways of incorporating the strategy, right? Same with infinite banking. Infinite banking, right, is my best way of summarizing this, is leveraging a properly structured whole life insurance contract to save money tax-free on a guaranteed basis and have liquidity via the cash value, which is a living benefit, where you borrow money against your policy to pay your debts off over time and build wealth simultaneously. That's a mouthful, right? Comment below if you agree. That's a bit of a mouthful. There's a lot that's going on there, right? So infinite banking is involving some kind of a product called whole life, and it has to be properly structured, and you have to be saving money into there. You have to be contributing money into the account. The money's going to grow, but then at the same time, you've got this living benefit of which you can use to borrow against. And if our goal is to pay off debts, you can now use an asset to pay your debts off while simultaneously building wealth in that time frame of becoming debt-free and beyond, right? So those are the most popular ways of getting out of debt.